The focus here is on that Fed announcement last week that they're going to be buying not just investment grade, but also high yield ETFs. Can you give us a sense of exactly which high yield and investment grade ETFs they're going to be buying? Or should we just assume they're only going to be buying the very biggest ones? There seems to be a lot of confusion about this. Can you clear it up for us?
Yeah, sure. Hi, Bob. In terms of confusion, the Fed gave some rough guidelines that said only ETFs that are focusing on investment grade ETFs. They've since added high yield. They gave some guidance in terms of not owning more than 20%. But in terms of like the specific ones, there was really no definitive guidelines. And it's not surprising to see that the market would assume that the Fed would go to the largest ETFs, and that's usually going to be the biggest with the most trading volume. We're wondering in terms of the benefit. That means it's probably going to go to the largest couple ETF issuers, and we're not necessarily sure that's the best move.
Yeah. What puzzles me about this is, first of all, that makes perfect sense to me. So you think like HYG and that there's your obvious one there, and some of the other ones, so like JNK. So those are now trading at premiums to their net asset value. The prices are higher, as if the market was expecting some big buyer to step in, which would be the Federal Reserve, of course. But the Federal Reserve has stated that they will not and do not want to buy ETFs when they are trading at a premium to their net asset values. So you have a little bit of a conundrum here. It certainly makes sense they buy the biggest ones, but would they necessarily be able to buy these if they're trading at a 4% premium to their net asset value right now, David? Is it a little bit of a... How do you resolve that?
Yeah, it's interesting. One of the loudest sound bites from the ETF industry was sort of this idea that fixed income ETFs can allow buyers to transact with sellers without investing in the underlying bond market. So you've now got these, the biggest funds that are the highly liquid. What's interesting is if we go back to sort of our, call it our ETF arbitrage playbook, and if you could see me, I've got my hands up kind of like goalposts, and on the left side you've got the price that the bonds could be sold. On the right side, you've got the price that they could be bought. As you rightly said, is the perception that ETF market makers could buy low and sell high when you start drifting towards those goalposts has kind of been tossed out the window recently with all this uncertainty, both on the selling pressure and honestly back on the buying pressure. And so when the ETF arbitrage wobbles, which is what we've seen recently, these funds start trading a lot more like closed-end funds, and you're going to see excessive discounts, which we saw 3 weeks ago, and now we're seeing the excessive premiums when all that buying pressure starts pushing those prices higher.
Right. Well, one of the characteristics of closed-end funds is discounts and premiums to net asset value, which is what we've been seeing. Jan, what about you? You run a high-yield fund, right? HYD, all right? I mean, are they going to buy? Is the Fed going to buy your fund? Do you know anything about that?
HYD is high yield munis, which we run, but we also run Fallen Angel, ANGL, and that is really going to be the epicenter of the bond world for 2020 for sure, because people have estimated between $250 million and $1 trillion worth of BBB bonds being downgraded to junk. I think this is interesting that the policymakers has said that ETFs are so important to the ecosystem that we want to get involved, because they didn't really get involved with ETFs in 0809. And although ETFs are small, they don't trade as much relative to mutual funds. I think they are providing a ton of pricing information, a ton of information about liquidity. And, almost the Fed doesn't need to do any buying of ETFs, because they can scare the prices around on the bonds and on the bond ETFs. It's kind of an interesting phenomenon. I call it's sort of an elephant. They have to be super, super careful about how they tread in this ecosystem.
Yeah. And just for people who don't know, the Fallen Angel Funds buys bonds of companies that have recently been downgraded to junk. How has the volumes been in Fallen Angel, Jan?
Well, it's been trading. I mean, it trades pretty well anyway. Something like, I'll call it $50 million a day on a good day. There's been inflows this year. It's definitely a trade that a lot of investors are looking at. The Fed's looking at it from a bailout perspective. In other words, their real focus is on investment grade issuers. But if an investment grade issuer has what I call a bad hair day, then they get downgraded to junk, and that's who the Fed wants to support.
Yeah. Tim, what's your sense here? Is you actively advise people on buying and selling ETFs? What do you think of all of this? This craziness with the corporate bond ETFs, with trading at premiums? We were trading at discounts to the net asset value, remember, a few weeks ago, and now we're trading some of these bonds, the corporate bond ETFs are trading at premiums to their net asset value. Do you have any thoughts for the average investor? Should anybody do anything about this at all?
Well, again, the Fed's looking at the plumbing of the markets, and that's where I think the Fed's done a pretty good job. And I agree also that I'm not sure that they have to be targeting specific issuers on the ETF side as much as they're targeting the underlying bond market. The moves in the HYG and the JNK to me are really a function of the market reacting to the Fed. I think you had short interest in both those ETFs that was massive by equity players that understood, and probably in a much more acute way than they did in 08, 09, where the credit markets were really leading the equity story. And so the short interest there was high relative to itself. The discounts to NAV were also there as a function of that. And when the Fed comes in and does something that they did on Friday, which will be talked about for years in terms of effectively socializing some of these debts, but protecting these downgraded corporates that have gone into junk. That's the reaction you get in the ETF. The highly publicized were the moves in some of them very household name ETFs earlier on the asset-backed muni side that I think is partially why this news flow is confused. But I think the Fed is targeting the asset class more than anything.
And David, would all this bond buying, this ETF bond buying by the Fed, make underlying bond trading any more or less efficient? For example, would it increase the amount of redemptions or creations of these bond ETFs that are out there? I know in the stock market, for example, with SPDR, 90% of the time, there's never any trading in the underlying stocks. I don't know what it is in the corporate bond ETF area. I presume it's probably 80%, maybe a little bit less. Would that change? And is there any hope that bond pricing can get more efficient? We know bond pricing has been a problem recently.
Right. So going back to the idea that the ETF serves as sort of the price discovery vehicle, certainly agree with that. And, the starting point is always going to be the value of the underlying securities. Now, one of the benefits of the ETF is it allows the buyers and the sellers to trade on exchange. To your question, how much of that buying ends up flowing into the underlying bond market? So for newer investment grade ETFs like our own investment grade fund, FLCO, it's almost 1-to-1. For every dollar that's bought on exchange, we would expect those to flow into the underlying bond market. For the super liquid ones that we've been talking about, that's sometimes only 20 cents on the dollar that trades on exchange actually goes into the underlying markets. So the concern is when the Fed wants to step in and start buying, they're not necessarily buying underlying bonds. They're actually supporting the stock price, which is going back to the whole discounts and premiums that we're talking about. So, the liquidity, would
that change? That 20% you mentioned, would that change? Would suddenly, instead of only 20% of the time as they're actually trading in the bond prices, would it go up? Would there be more? Would it be 30% or 40%?
Yeah,
what I'm looking for is some hope that we could improve bond pricing a little bit. For crying out loud, let's bring bond trading into the 21st century, maybe more electronic trading or something like that. I'm trying to look for something good to come out of all of this.
Oh, I think the overall desire to have more transparency into the fixed income trading of the bonds, I think that's been clear. And whether the percentage is 20 cents, 40 cents, even up to 60 cents, and usually the percentages will go higher as you get one-directional trading. But still, the premiums and discounts will be certainly driven by the accuracy of those trades in the underlying bonds.